Welcome to The Explainer. Today, we're tearing into Klarna. We've got a brutal post-guidance sell-off on our hands, and the question is simple. Is this a textbook value trap or literally the ultimate contrarian buy? Let's get right into it.
Okay, let's dive into this. What exactly is Klarna today? I mean, we all know them as the Swedish pioneer of buy now, pay later, right? But honestly, you have to look way beyond simple installments at this point. They've got over 120 million active consumers. To put that into perspective, that's roughly a third of the US population. Plus, they've got over 1 million retailers on the platform. What we're seeing is an aggressive shift. They're transforming into this everyday financial ecosystem, pushing into consumer payments, debit products, and heavy AI-powered services. They don't just want to finance your sneakers anymore. They want to be your digital bank.
So, to really understand why this stock is currently fighting for its life, we need to trace the timeline of the market's reaction. It's been an absolute roller coaster. In Q2 of 2026, they posted undeniably strong earnings. Everything looked fantastic. But then, bam, the hammer dropped. Management suddenly lowered their full-year 2026 guidance, which immediately triggered a massive downward revision in expectations for Q3. And if that wasn't enough to spook everyone, they announced major executive leadership departures slated for 2027. So literally in the blink of an eye, the market went from cheering a great quarter to a full-blown crisis of confidence. Let's rewind for a second and break down that Q2 performance, because it was wild. Plus 27%. That is Klarna's year-over-year revenue growth for the second quarter, hitting a massive $1.042 billion. Look, for a company operating at this scale, accelerating top-line revenue by almost 30% is a huge testament to their global distribution network. And they are seeing some seriously surging momentum in the United States right now. Now, what's really interesting here is that while revenue growing at 27% is great, look at the 42% growth in transaction margin dollars. That right there is textbook operating leverage. It basically means their profits are growing significantly faster than their costs, especially as users start adopting higher value products. It tells us that Klarna is becoming way more economically efficient. Their underlying business engine is actually revving up much faster than that headline revenue number suggests.
And that brings us to this highly anticipated, absolutely massive milestone, a $9 million net profit. Finally, after quarters of heavy cash burn and just staggering losses during their whole growth at all costs era, Klarna officially crossed the threshold into the black. Their adjusted operating income shot up an incredible 214%. Honestly, from a purely rear-view mirror perspective, Q2 was a masterclass in execution.
But as we all know, the market pays for the future, not the past. Wall Street was modeling for full-year 2026 gross merchandise volume, which is essentially the total value of all the goods sold through Klarna, to top $155 billion. But then management dropped the new midpoint, $150 billion. On top of that, revenue estimates were slashed from $4.34 billion down to just around $4.1 billion. It was this sudden, market-shocking reduction that completely derailed the entire bull narrative.
So what exactly drove this drastic cut? Well, management pointed to a few specific catalysts. First off, weaker consumer discretionary spending. They specifically highlighted a notable softness in the German market, which, by the way, is historically one of Klarna's most critical regions. They also cited some foreign exchange translation effects. But crucially, and this is a big one, they announced the upcoming departures of both their chief financial officer and their chief marketing officer. I mean, losing your navigator and your engine simultaneously in a newly public growth company? That's a massive red flag for institutional investors. Wall Street absolutely hates uncertainty.
Which leads us to the single most critical question every Klarna investor has to answer right now. Is Klarna experiencing a temporary European slowdown, or is its growth model structurally slowing? Just take a second to let that land. Because if this is just a macroeconomic blip, the stock is an absolute steal right now. But if the buy now, pay later model is hitting a structural ceiling, well, the pain is just beginning.
Okay, for those looking at the upside, let's examine the bull case. And to be fair, there is genuine enthusiasm warranted here. Klarna has built this massive distribution network of 120 million users. Think about it. You don't even need explosive user growth if you can just monetize your existing users better. And actually, revenue per active consumer jumped 24% in Q2. Plus, U.S. gross merchandise volume surged by 27% year over year. The U.S. is rapidly becoming their fastest-growing major market. You combine all of that momentum with pending U.S. banking license applications and these super aggressive investments in AI that are radically driving down their operational costs, you can see a very clear path to a highly profitable, dominant global financial platform.
However, we have to flip the coin because the risks here are very real.
The bear case stems from the fact that, fundamentally, buy now, pay later is a credit business, period. It is highly vulnerable to economic downturns and rising credit loss vulnerability. If that consumer weakness we're seeing in Europe deepens, or worse, spreads over to the US, delinquencies are going to spike, and that will completely erase those beautiful margins. Plus, management has severely damaged their guidance credibility. Add in the heavy, relentless competition from giants like PayPal, Apple, and legacy banks, and there's a real threat that BNPL just gets turned into a commoditized feature rather than a standalone, highly valued business.
And this brilliantly illustrates where Klarna stands when you stack it against its biggest pure-play rival, Affirm. Stark contrasts emerge here. Notice the 5-star rating for Klarna's consumer scale and international presence. They are really leaning on that massive worldwide network. Affirm, meanwhile, sits at 3 stars for global scale, but matches Klarna with 5 stars in U.S. growth because they rely so heavily on their domestic dominance. Look, both of them face high credit risk, and both have significant banking opportunities, but Klarna's ultimate edge here really lies in that worldwide brand recognition.
So, how is the market pricing all of this uncertainty? Well, after a pretty brutal 23% single-session drop that sent shares tumbling down to around $15.06, the valuation mechanics have completely shifted. Klarna is now trading at roughly a 1.4 times price-to-sales ratio, and that's based on their revised 2026 revenue guidance. For a fintech company putting up double-digit growth, a 1.4x multiple looks undeniably almost screamingly cheap on paper.
But we need to remember the golden rule of analytical investing. Low valuation does not automatically mean low risk. The market isn't stupid. It is assigning a heavy, heavy discount to Klarna precisely because of those unresolved profitability and credit fears. A cheap stock can always get much cheaper if the underlying business fundamentals start to crack.
Let's run through the 2026 to 2030 scenario analysis. If you're betting on the bull case, we're looking at a valuation somewhere in the $30 to $45 plus per share range. But to achieve this spectacular multi-bagger return, Klarna has to execute flawlessly. This scenario absolutely requires U.S. growth sustaining above 20%, transaction margins continuing to outpace top-line revenue, credit losses remaining strictly under control, and ultimately, they need to restore institutional market confidence. They have to prove they are a highly profitable ecosystem, not just some trendy lending app.
Moving to our base case valuation, this logically sits between $22 and $30. This assumes that revenue growth cools off and settles down to a more mature 15 to 20% range. It definitely accounts for a sluggish European market dragging on overall GMV, but it still expects Klarna to achieve sustainable platform profitability as those margins gradually expand. So even in this moderate, middle-of-the-road scenario, there is meaningful upside from where the stock sits post-sell-off.
But here is the bear case, a grim valuation of $8 to $12. This highlights the very real downside risk and proves exactly why this stock is not some safe bargain for the faint of heart. This scenario is triggered if we see deteriorating consumer credit, rising defaults, and just margin-crushing competition. If U.S. expansion suddenly gets too expensive and growth stalls out, the floor on this stock is much, much lower than where it is today. So the crucial point is that investing in Klarna right now really comes down to the ultimate trade-off. On one hand, you have fundamentally improving underlying economics, like that fantastic 42% transaction margin growth we talked about, showing true operating leverage. But on the other hand, you have this looming, very real threat of deteriorating shareholder value driven by credit defaults and macroeconomic weakness. Basically, you're placing a bet that the structural margin expansion is going to outrun the credit cycle risk.
Let's summarize all of this with our final analytical scorecard. The U.S. opportunity gets a stellar 9 out of 10. Margin potential is looking very strong at an 8.5. The valuation is highly compelling, scoring an 8. But the balance sheet and credit risk pull that score down heavily, coming in at a 5.5. Overall, this nets out to a 7.5 out of 10. So we confidently classify Klarna as a speculative buy, and it sits firmly in a very high-risk profile category. Which brings us to our bottom line assessment. KLAR could become a major fintech winner, but investors are being paid to take substantial execution and credit risk. If you're a high-risk investor with a pretty strong stomach for volatility, our analysis suggests utilizing gradual accumulation zones, specifically looking at that $13 to $16 range, rather than just blindly committing to a full immediate position.
And that leaves us with one final, provocative question as we look ahead. Will the next few earnings reports prove this massive sell-off was a great contrarian entry point, or just the ultimate value trap? The upcoming Q3 results, specifically checking to see if that revenue hits their new $940 to $980 million guide, will definitely give us our first major clue.
So keep a close eye on the data, stay objective, and keep learning.